Have you ever wondered how your bank actually makes money, even from an account you think is completely free? You're probably thinking, I don't pay any fees. I have a free savings account. But here's the truth. Your bank is earning money from your account, from your transactions, and even from the money just sitting there every single day without you ever noticing. In today's video, I'm going to break down exactly how banks quietly pull money out of your pocket. Stick around till the end, because the last point is something almost nobody talks about. Let's get into it. The first and most common way is the minimum balance requirement. Banks require you to maintain a certain amount in your account, say $500 or $1,000, depending on the account type. If your balance drops below that threshold, even for a single day in the billing cycle, the bank automatically deducts a penalty fee. This can range from a few dollars to $15 or more every month. And most people don't even notice until they actually sit down and check their statement. Here's the key thing though. The bank does zero extra work to collect this fee. It's pure, effortless profit. Now here's the most important point in this whole video. The interest banks pay you on your savings is typically around 0.5% to 2% per year. But that same money, when it's lent out to someone else as a loan, earns the bank 10%, 15%, sometimes even 20% or more in interest. This gap has a name. It's called the interest spread. In simple terms, the bank is using your money to lend to someone else. And the massive difference between what they pay you and what they charge borrowers, that's their core profit engine. Let's put real numbers on this. Say you have $10,000 in your account. The bank pays you 2% interest. That's $200 a year. But that same $10,000 gets loaned out as a credit card balance at 18% interest, earning the bank $1,800. That $1,600 difference goes straight into the bank's pocket. You've probably noticed this one yourself. After a certain number of free withdrawals each month, ATM fees start kicking in. Use another bank's ATM, even higher. These fees look small, $2, $3, maybe $5. But multiply that by millions of customers making these transactions every single day. Suddenly, these small fees add up to one of the most reliable income streams a bank has. Credit cards are basically a goldmine for banks. If you don't pay off your full balance on time, you get charged interest anywhere from 20% to 30% annually on the remaining balance. And here's what makes it worse. This interest compounds monthly, meaning you start paying interest on top of interest. On top of that, there's a separate late fee if your payment is delayed. A lot of people just pay the minimum due, thinking they're in the clear. But interest keeps accumulating on the remaining balance every single day. That's how a small bill can balloon into a massive debt in just a few months. Now let's talk about the fees most people barely notice. Annual charges for SMS alerts, fees for duplicate statements or extra checkbooks, account closure fees, even a charge just for requesting a simple balance certificate. Each one of these looks tiny on its own. But add them up over a year, and you'll find they quietly amount to a surprisingly large sum. Money you probably never even realized you were spending. Here's the point almost nobody discusses. When you deposit a check or make a transfer, that money doesn't clear instantly. It can take a few hours, sometimes a full day or more. So where does your money sit during that time? It sits with the bank. And during that window, the bank can actually invest that money and earn returns on it. This is called float. Now imagine millions of customers' transactions sitting in this in-between state every single day. That's an enormous pool of money the bank gets to use for short-term investments, while you're just sitting there thinking your transaction is processing. Last point, if you've ever visited a bank branch, you've probably been offered an insurance policy, a mutual fund, or some other investment product. Banks earn a commission every time they sell these. Often, these products aren't necessarily the best option for you, but bank employees have sales targets to hit. So next time you hear about a special offer at your bank, it's worth pausing for just a second to ask, who actually benefits from this? So those were 7 ways banks quietly make money from you, often without you ever realizing it. This doesn't mean banking is inherently bad. It just means understanding these mechanics helps you make smarter decisions with your own money. If you found this useful, hit like, subscribe to the channel, And let me know in the comments which one of these you didn't know about before. See you in the next video.